This example of Mondelez's stock chart begins with a long-term uptrend that experiences a strong reversal stemming from a sharp peak. The peak is comprised of one large red candle that is certainly no hanging man or bearish star. However, it manages to demonstrate strong bearish sentiment, especially as it is significantly larger than the comparatively small bullish candles that precede it. In fact, when this is combined with the candle before and after it, it forms the general evening star price action. After a minor delay, there is the classic acceleration with 3 black crows that eventually leads to downward overextension. Similar to most stocks, there was a large drop in late August 2015. Except in this case, the drop halted quite quickly due to a large bull hammer with a slightly longer upper wick than normal. The market remains mainly indecisive due to not being able to immediately close above the bull hammer's high. There is a minor incline, however this is more of a passive rise, once again following downward overextension from 3 black crows. The volume is bullish but not exceedingly high, though it does remain consistent. Speaking of consistency, there are consistent bearish stars. There's also an evening star here, though bearish sentiment isn't exceedingly strong. The market moves under, however it's not exceedingly low, and the overall selling volume is not that high compared to the relatively consistent bullish volume that remains. There is a minor downward acceleration towards the end of September, however nothing much comes of it due to the opening price from the large bull hammer holding a strong support. A clear demonstration of how opening and closing prices generally have higher importance, especially when defining support and resistance levels. After rejecting the move back into the low 40s, bullish volume becomes even more consistent, but still not exceedingly high. A bearish engulfing forms near record high ranges, and as usual, there is greater confirmation of increased bearish sentiment when there is a strong close under the low of the bearish engulfing. This does indeed happen with increased volume as well. However, it is a familiar sight where there is a bull hammer. This is not a bull hammer in the normal upswing reversal context. However, it does show the market is pushing back against the drop, and this can lead to a delay in the development of a downtrend. A strong bullish candle essentially negates the price action of the past 3 candles, though it still struggles at this upper range where there is also upper wick rejection. Similar to the 4112 level from the open of the large bull hammer, the 4681 level from the close of the record high candle remains highly influential. Except in this case, it is a bearish context where there is resistance to the uptrend, and even though this once again is no bearish star or hanging man, it demonstrates the overall greater importance of opening and closing prices. A look back at the longer term context emphasizes the importance of these new record high ranges. In the short term, the market takes a more neutral to slightly bearish posture, where activity mainly concentrates around the price levels that are from the general evening star price action around the record high peak. There is lower wick rejection with these candles to indicate short-term opposition to lower selling. However, unless there's a major bullish spike over the 46 range, there will be no bullish continuation back to all-time highs. The overall sentiment still remains neutral to bearish. This is more of a slight delay prior to a downward acceleration that comes as soon as the market begins to close strongly below these past few candles back to the area where the bearish engulfing was initially forming. It appears to be more of the same. However, the market is moving slightly more bearish as the last two candles have begun to close lower. There is a downtrend emerging that does resemble the general three black crows price action, especially with gaps between the real bodies of the large red candles, though it isn't exceedingly strong because most of the candles during the steepest part of the drop have longer lower wicks. That means there was bullish opposition prior to stock price flattening. The downtrend does proceed quite strongly at times with these major downward continuations, though along the way during these resting phases there are plenty of bullish candles, and not surprisingly they form around the 42 to 39 range that is derived from the major levels around the large bull hammer back in August. This same 39 to 42 range is recontacted following a major upswing that forms from a mainly passive rise. Once again, there is major downward overextension, consistent but not exceedingly high bullish volume, and this allows stock price to rise with almost no selling opposition. On closer inspection, a large piercing pattern forms the pivotal upswing, and yes, there is minor selling pressure at the 39 area because it is the natural first resistance to the developing uptrend, but overall, there is almost no selling pressure after the downward overextension. Selling pressure does begin to form a minor downswing because the low 40s also present resistance to the developing uptrend, though the key lower boundary at 39 remains, and that leads to a bullish continuation. Naturally, resistance begins to increase as price continues to climb, especially near the top of this intermediate range that continues to have major influence. In the short term, bearish sentiment is not exceedingly strong, especially since there is a delay to a downtrend's development, and bearish volume is not exceedingly high. Even if there is a bearish acceleration to build on these lower closes, there is still significant support offered at the lower boundary of this intermediate range. A sustained long-term horizontal range forms due to sustained resistance at the 46 area and continued support from the large bull hammer from the 39 to 42 level. Late October demonstrates another case where there is a reversal from one single large disproportionate candle. This is no distinct candle pattern on its own. However, the large downward overextension in the short term is very apparent. It is a similar situation with this large green candle showing short-term upward overextension, though it is closer to more familiar candle patterns with its longer upper wick, similar to the general bearish star price action that precedes it, and this also forms at an established resistance, similar to how this candle formed at established support. This is somewhere in the spectrum between three black crows and less clear three methods falling, though overall the large red real-bodied candles show short-term downward overextension. Naturally, there is support offered in the low 40s as price almost completely halts moving downwards from a near absence in selling volume. And during the upswing, there is another demonstration of general U-shaped price action, not a morning star, but rather a combination between a harami and bullish engulfing. It is a representation of indecision and bullish sentiment increasing. When these three candles are combined, they essentially form a dragonfly doji, and that is quite appropriate given it shows indecision and bullish sentiment as well. Eventually, the multi-year range is breached when there is a major downward continuation with more than adequate bearish volume and price action. Just by looking at the overwhelming quantity of red days on the chart demonstrates an overwhelming bearish context, making the breach of the key 39 level less surprising. When there is a major upswing, it is no exact morning star. However, once again, there is the same general U-shaped price action, and it is also good to see the features of volume, where the second candle has comparatively lower volume compared to the first and third candles. Also, the second candle is smaller and relatively balanced to demonstrate similar deliberation in a morning star. The large bullish engulfing is a strong start for this uptrend, which finds natural resistance at the 39 level, which remains significant, now offering resistance. Taking a look back with the longer term context reveals that 37.5 was a natural major support following the breach of the 39 level, especially as it had a major impact on trading in the past. It is a familiar sight with a more passive rise to begin. Bullish volume is not exceedingly high but remains consistent at the start, following the downward overextension. Stock price climbs higher into the 40s with relatively low selling pressure, and during the development of this uptrend, there are minor downswings which are good for stabilization, and no major downtrends emerge due to these key levels holding as support. Eventually, towards August, the uptrend begins to accelerate with increased bullish volume that manages to re-establish these upper intermediate ranges. Currently, there is resistance around the closing price of this bearish star and the open of the bearish candle following it. This is another example demonstrating the generally greater importance of closing and opening prices. The current candle has a noticeable lower wick. However, it is demonstrating the overall price action of a bearish star with increased volume as well. High and low prices of candles can also still have influence, as seen by the 44.23 level from the bearish star's high that has influence on the current candle. Though this is shorter term influence, and speaking of the short term, there is a strong close lower, however with significantly lower volume. A downtrend is possible, but it is less likely if the market doesn't begin increasing the bearish sentiment with higher red volume. There is a minor increase in bearish volume for a close lower as well. However, most of the bearish context seems to be coming from the price action rather than the volume, particularly from these three candles that form evening star price action, and all of them have longer upper wicks. The end result is a volatile and moderately paced drop. Most of the acceleration comes from these two large bearish candles, and naturally, similar to Three Black Crows price action, it results in temporary downward overextension. This leaves room for bullish sentiment to develop on the still influential 41.12 range, offering support and the longer lower wick of the current candle. No major upswing emerges. Instead, this is more of a neutral phase in a small downward continuation to breach 41.12 to demonstrate that nothing is ever guaranteed, even if the candles show strong bullish intent. Broader context always needs to be taken into account, and also here, towards the end of October when the downward continuation finishes, there is no Three Black Crows price action, though similar strong bearish moves are seen due to the large gaps between the red candles. Lower wick rejection is often present at these lower boundaries that originate from the large bull hammer in August 2015. Increasing bullish sentiment finally clears the 46 range, and after that there is a normal consolidation, a slight downswing where there is a morning star that forms to finish off the bullish continuation. This bullish background is adequate to finally surpass the 48 level, where there is still some minor hesitation and resistance as seen with these dojis prior to the decisive close higher. Overall, it is a stable rise to newer highs that is eventually reversed due to the broader stock market decline in early 2020 that does begin with this large harami, which is a precursor to the main reversal. It demonstrates the gradual shift from the uptrend to more indecisive price action with increasing bearish sentiment that is fully realized after this dark cloud cover. A clear bullishly engulfed bull hammer leads to a rapid upswing that is less significant given the broader bearish context. Temporary gains are quickly reversed and the downtrend continues. However, similar to an uptrend that is stabilized with minor downswings, this major decline is stabilized by minor upswings. And as usual, it is natural to see reversal candles form near major levels of support to slow down rather than reverse the overwhelming downtrend. These previous ranges still remain influential as they offer support. Even during this major downtrend, there can still be some bullish sentiment, at least in the short term, and that is seen by this morning star. Very clear bullish price action emerging, though short-term volatility remains high. Another example of a more passive rise to begin, where downward overextension is followed by lower but consistent bullish volume. After the initial rebound, there is a minor stall due to re-emerging selling pressure, but it doesn't get to significant levels as seen with the volume. A close-up here sees one of the minor downswings, which shows general evening star price action with bearish intent that is not built upon as the market doesn't begin strongly closing lower. 57.25 remains a focal point of resistance due to the earlier harami that was a precursor to the major downtrend. Naturally, there will be a higher concentration of interest here due to more market activity as seen by the high volume in this harami. This also demonstrates the overall greater importance of opening and closing prices, except in this case with a 2-candle pattern,